this live. It's going to be educational, and we're going to have a great time here. You guys know the drill. I know that it's lame, but I got to drop a disclaim. I ain't no legal financial tax advisor, but I do make every single one of you, my family, my friends, and my neighbors, a whole lot of wiser. My lawyer, I have to do it by law, ladies and gentlemen. So we're going to get right into it, ladies and gentlemen. So today, we're going to be talking about a very powerful concept called infinite banking. For some of you that never heard about infinite banking, it's basically what do we do? Most of my clients, yourself, when you guys get the money from your job, your careers, what do? You take that money and you put that money into the bank. Why do we put the money into the bank? I mean, do you think the bank is safe, Andrew?
No, I don't trust that, man. At this point, I jump banks all the time. That's why it's very crucial for our business.
Now you understand, right? But a lot of people, right, they would think that, oh no, banks may be safe. We see them all over town, and by seeing them so often, people tend to build a trust, but they don't know, what the banks are doing. So we tend to put our monies in the bank, and we see a little code in there, FDIC, right? A little sticker. You guys know what that stands for, ladies and gentlemen? Funds don't increase correctly. No, I'm just kidding. It means Federal Depository Insurance Corporation. And why? The most important word here is the little I, and I will get into it here in a second. Did you guys know once we put our money into the bank, they only give us back 0 to 1%, and we have to pay taxes? Isn't it sucks? Like 0 to 1%, and we got to pay taxes. But have you guys ever wondered what do the bank do with their money? The bank put their money with insurance companies, which are the most powerful companies in the planet. If you guys think about it, right? Billions of people are paying insurance on a monthly basis for their car, their house, their mortgage, their businesses. What if it's not enough claims? What are they doing with all that money? It's just piles and piles and piles of cash, trillions and trillions of dollars at their hand. They control the planet. When governments, when banks, when companies are in trouble, who do they go with? The insurance companies. But they don't want you to know this. Why? Because they give the bank back 6 to 12% on average, and it's tax-free. But the bank only gives us 0 to 1%, and we got to pay taxes. I wonder why it's not a benefit for the banks or the corporations or the government to teach this and make this information readily available. It's just something to think about, right? Because now, did you guys know that for every $1 million that the insurance company insures you and your family, your business, they got to have 10 times as more reserve. So let's say, Andrew, you have your sweet garlic company. You need an E&O. You need insurance for like $1 to $3 million. Let's say if it's $1 million, they got to have $10 million in reserve to insure your business or your life or your house or your car. 10 times more reserve. The bank is the opposite. It's 1 to 10. Isn't that crazy? So that's why banks are very dangerous. Like in 2008, 60% of all banks went out of business. Only 40% of banks were alive, and it was because the government printed enough cash and gave it to them so they wouldn't collapse like back in the early 1900s, where people were not able to withdraw money from the ATMs. You see, people don't talk about those things. I want you guys to be educated so you can start doing what the wealthy do. How come Ray Kroc, the founder of McDonald's, and Walt Disney, and the Rockefellers, and all these richest families, they keep the wealth increasing and transferring from generation of generation over the last 100, 200 years? How come they don't pay taxes? How come the money keep growing? How come they don't lose when the economy crashes it? Have you guys ever asked that question and went down the rabbit hole? It's so much is out there that I was talking to a graduate from Stanford and Harvard, and he was blown away. He's like, you got to come over here and teach our students. Guys, think about it. Not even Harvard and Stanford is teaching this. Imagine society. What I'm about to share with you here with you guys today, a lot of people are not going to be happy about, because it's a very powerful concept that anybody can do it, become the bank themselves. For as low as $3 a day, you can start saving $100 a month and become in the bank and teach your children, your loved ones, and you see how this would all build it up together as we're going to build the bank here today with Andrew in real time. It has never been done. We're doing something today. We are debunking all the BS that is out there, the things that financial advisors and agents and insurance advisors and family offices that they will not tell you. Lawyers will charge you $5,000 to $10,000 an hour to teach you what I'm about to share here today. So what I'm saying, ladies and gentlemen, instead of you do with your money and put it in the bank, you should do what the bank is doing with your money, which is put your money directly with insurance firms, where now you get 6 to 12% returns and tax-free. And that's the concept of infinite banking here in a few minutes, so that you guys can teach this to your children, teach this to your loved ones, because the banks, they don't want you to know this. The government doesn't want you to know this. The corporations for sure doesn't want you to know this, because they want you to put your money in the 401k. They tell you it's going to be your retirement. It's not your retirement. It's Uncle Sam retirement, because when you get 65, 50% of that goes to them. We'll get into that later. I'm going to tell you guys over here a little quick about the rule of 72. Albert Einstein called the 8th wonder of the world. It's basically you take whatever interest you are receiving right now in your investments through your banks, your CDs, and you divide the interest into 72. And whatever the number is the number of years that takes for your money to double. So let's say, Andrew, you are 29 years old and you have $10,000 and you put that in the bank. Let's say the bank is giving you 1%. You and I know the bank is actually giving us 0.1%. So if we divide that, it will take you 72,000 years to double your money. Well, let's just say 1%. It would take about 72 years for your money to double. No, I don't know about you, Andrew, but I don't have that type of money to double my money, brother. You feel me?
Yeah.
So,
yeah.
And then I'm telling you, man, we have a saying, in Portuguese, it's like melhor sorrir do que chorar. It's better to laugh instead of crying. But now let's say if you get 4%. Now, if you get 4% and you divide 4% into 72, your money will double in 18 years. You get a little bit better.
Yeah.
Now, at 29, you have 10,000. At 47, you get 20,000.
Mm-hmm.
And over here on the farther right side, that's when the big players, when you start getting 6 to 12%.
Yeah, there it is.
That's what the banks and the wealth are doing, right? Now, when you get 6 to 12%, your money doubles every 6 to 12 years. It's a much better time than waiting, like having the money in the bank, not doing nothing, but having the banks using our money. You guys just found out and figured it out, the truth. Because now look at the difference over here on the right columns. When you start getting 6 and 12%, even let's just be humble here and stay at the 6% range.
Mm-hmm.
Now you have 10,000. By 65, now you have 80 grand.
Wow.
So that money will grow very, very much faster. And, if we use the rule of 72, let's say hypothetically you guys are getting, I always tell when I'm speaking at universities and talking to children, I always say, by the time that you guys are 30, every 30 and 40-year-old should have at least $1 million saved up. But unfortunately, the reality is that 99% of 30 and 40-year-olds, they don't have that type of money. So we want to help them get there, because when you get to $1 million, now we can use that money and put that money to work for you versus you working for the money. Because let's say right now you are starting, you have a little 401k, 125,000. We put that into a vehicle instrument. And let's say if you are getting average 7.2 annual returns, you take that, divide into 72. Now your money doubles every 10 years. Now you have 125 in 10 years. You get 250,000. Then you have 500,000, another 20, and then you have $1 million when you're 30. But here's the problem, Andrew. $1 million is not enough. And I'm going to show you guys why $1 million is not enough. Because even if you guys have $1 million right now and you come to me and I help you get 7.2% annual returns on average that my people are getting, that's 72,000. Let's say 1/3 that goes in taxes. That's 48,000 net to live on, 4,000 a month to pay your mortgage, your rent, your bills. For 4,000 a month, when we adjust that into inflation, let's say inflation is at 5% right now, is way higher. Well, let's just say we'll go back to normal, and we will manage to go back to 5%. Take 5%, divide into 72. Again, the rule of 72 can be used for compounding inflation rates of returns. So if you take 5 and you divide into 72, you're going to get 15. So therefore, the cost of living would double every 15 years if we can get inflation to go back to 5%. Inflation is at 10% right now, was at 15% last year. Do the numbers. You don't want that to happen. Trust me. The reason why we don't want inflation to keep going higher, because here's the problem, guys. They print 100 years of cash in the last 2 years. Somebody gonna have to pay for that. You're gonna have to pay for that. I'm gonna have to pay Andrew or children or grandkids.
Yeah.
And here's the problem. Even if you have $1 million right now, the reason why $1 million is not enough, because when we adjust that into inflation, now you're gonna need $8,000 a month to pay for what $4,000 used to pay 15 years ago. You guys probably noticed that already for some of my older friends over here watching and listening. And guess what? Some of you guys are younger. You are eating Andrew's garlic, and we're going to be living for a very long time. Guess what? 30 years down the line, that was a good one.
Yeah.
30 years down the line, now you're going to need $16,000 to pay for what $4,000 pays today. Like you pay your mortgage, your rent, your car insurance, your food and your bread and your meat, or you're vegetarian, your vegetables. Have you noticed that the price of all those items and gas went
Everything.
up?
Yeah.
Well, now, 30 years down the line, you need $16,000 a month to pay for what $4,000 pays for today. Your purchasing power goes to 1,000. So I really hope you guys are following me here. This is all mathematics, because I want you guys to understand how critical this is so that we can help ourselves and our loved ones. And that's why you guys see me doing free education about money and mindset all the time. I'm like a preach, and I'll keep preaching to my last breath, because this is so important. And unfortunately, money and death is a taboo, and we don't talk about it at the kitchen table. But we're going to change that. We're going to start preaching and sharing this education. Like right now, we are recording this. It's going to be out there in a podcast episode. The video is going to be saved on Facebook and LinkedIn, so we can always refer to it, show it to our loved ones. And if you wanted to go in depth for yourself and your family, I'll be happy to do a Zoom for you or your family, where it's private between you and I, or you and I and your family. So now, here's the problem that I was telling you guys. If we use the same rule of 72, inflation last year was at 15%. Thank God we went back to 10. But if we would have continued at that 15, cost of living would double every 4.8 years. Remember the numbers that I was showing you guys? The $16,000 in the last slide?
Yeah.
Imagine. That means like 8 years from now, if you spend $4,000 a month right now to pay your bills, you would need 16 grand to pay for the same exact items. You tell me how much chaos you see on the streets. Everybody, a lot of people will be homeless. A lot of people will be freaking out. Total chaos. I don't want to go there, but it's something that we have to be aware of it. And you need to start saving now. I don't care if it's $3 a day, $100 a month, or $200 a month. That's the only way that you're going to be able to counter inflation, by having your money grows tax-free, to help minimize the chaos. So you have enough. Basically, you got to put any money you have left to work for you. I don't care if you have to work part-time, drive an Uber, whatever it takes. Just put $100, $200, $300 a month to work for you as you do your work. We're going to teach you guys a few cool things over here. How money gets taxed. Tax now, things that you guys already know. Bank accounts, CDs, stocks, mutual funds. Tax later, 401k, 403b, IRA annuities. Here's the problem with tax later. It's not your retirement. It's Uncle Sam retirement. Let's say you're 30 years old and you have 500 grand right now in your IRA. When you're 65, let's say you have $1 million. Guess what? You got to give Uncle Sam half of their money. 50% has to go to Uncle Sam. So it's not your retirement. It's Uncle Sam's retirement. Why would you do that? What I tell people is to pay the penalty now, because right now taxes are cheaper. Even if you pay the penalty now and you cash out your 401k, let's say you pay your 10, 30, 40%, might as well take the hit now, because what do you think taxes is going to be, Andrew, later on down the line? If taxes now are this high, if we just printed 100 years of cash in 2 years, what do you think taxes is going to be 30 years down the line? Is it still going to be 30, 40, or is it going to be 60, 70%?
You'll be left with nothing by then.
It's exactly where some European countries, they charge 60, 70% taxes.
Wow.
So, you know what I mean? It's like, it's all mathematics, guys. It's mathematics. And that's why I preach tax never, which is my favorite ones over here on the bottom, because even municipal bonds and the Roth IRAs, there are a few implications in there. And that's why I love tax-free retirement 7702A. The crazy part, Andrew, that when you ask a financial advisor, any money advisor, you know, people in money, a lot of them, they don't understand it about this special code that was created by the IRS by the early 1900s, back in 1913. Ask your advisor, ask anybody that's telling you a money advice, do you understand how the 7702A code works? 72E, and they have no idea how those tax codes work. The reason why they don't, because the products that the billionaires been using those products for, they can grow your money tax-free, and the commissions are very little for the advisors. So it's not in their best interest to share with people. I'm debunking and sharing all those things, and we're going to go more into it. I want to share with you guys over here a little quick how money grows. I want you guys to, how would you like your money to grow, ladies and gentlemen? Would you like your money to grow like in a bank, where it would take 72 years or 72,000 years for your money to double? Would you like to have your money in the market? And look what happened back in 2001 and 2008. People lost half of their money, and they were not able to retire because there were too much money in the market. Stocks, CDs, mutual funds. We've been on a melt up for the last 10 plus years. It's gonna have to come down, and it's gonna come down strong. If you are 55 to 64 years old and you're gonna retire, I pray that you message me. I pray that you look into this deeper. Because if you're still in the market, you're in a risk of losing half of your wealth. And you're in the risk of not being able to retire and having to go back to work, and you already paid your dues. This is a very serious matter, ladies and gentlemen. Share this with your mom, your pops, your grandparents, everybody that you love between ages 55 and 64. And I'll be happy to give them a free wealth strategy session value at $5,000 an hour and no cost. Because the way how you want your money to grow is through index. You don't want to be in the market. You want to follow the market. You want to do what the billionaires do. You want to do what the banks do with their money. Where when the economy crashes through market losses, manipulations, or any government irresponsibility and not being able to manage money. I don't want to go too deep into that. But you want to have your money index, where it follows the market, follows the S&P. So when the market crashes it protects your principal 100%. You don't gain nothing, but you don't lose nothing. That's how the billionaires and the wealthy been doing for hundreds of years. And when the market goes up, it goes up with the market, and it locks the gains. If the market crashes after that, guess what? You don't lose anything. It grows every time, and it locks in with the market. Index. Very, very powerful. Not that many people are teaching those elements because, again, there's a lot of things out there that they don't want you to know. I won't go too deep into this one over here. This is like government qualified plans. People that have 401ks. As you guys, I was telling you guys earlier, look, even if you take the money too soon, you got to pay all these penalties. If you wait until 65, you got to give half. If you don't take it until you're 70 and a half, God, Lord, you have your RMDs, require minimum distribution. 401ks, all these government plans are too bad. 403, 401k, 401(3)Bs. Too many rules, regulations, fees. If you're a married couple, you pay about $155,000 in fees over the next 30 years. It's not good. They don't want you to know that. Companies definitely don't want you to learn other things outside 401k because now you're not going to be giving that money to them.
Yeah.
So trust me, there's a lot of things that corporations and banks that don't want you to know, but I'm debanking them. It's no protection in 401k. A lot of, if you know, death tax, inheritance tax, there's a lot of stuff out there. This thing was created back in 1978. Me personally, I will never have my money in a 401k anymore. And I hate to see anybody else go through, or many of people went through in 2008 and 2001 when they lost half of their nest egg because of what happened back in 2008. And we can prevent all that from happening now, because there are things out there like fixed index annuities, where let's say you have 200 grand, you can lock it in that money. I like to use the GRIP 5, which is pretty much a guarantee those rates of returns. Some of those indexes out there, when you lock the money 5-7 years, you get about 6% annual rate of return. You already know 6% into 72. Now the money doubles every 12 years. It follows the indexing strategy where your money's protected along the way, as you guys can see over here on the top of every mountain. So you don't lose when the economy goes down. You can use it as a pension income for life. And you even get a little bonus by moving your money into some fixed index annuities. So very close. You guys can see over here, somebody age 50, let's say if they have 200 grand, they get a little 5% bonus. Now they have 210, 6% annual rate of return. At 51, they got 222. 12 years down the line, 444, and then another 12 years, 888. So it's all mathematics, simple math equation, things that are out there. But again, a lot of people, they don't want you to understand this. And here's I'm going to teach you guys a very powerful thing, tax-free retirement, where we combine the safety of the bank, high rates of return. In the last 40 years, they've been averaging about 10% a year. And then also insurance, which makes tax-free. When you combine those three things together, you create the IRC 7702A that was established in 1913. A group of men, I'm going to take you guys through history. They came to America and they say, okay, Uncle Sam, we bring in all this gold and diamonds and money from overseas, and we want to put this money here in America, but we don't want it to pay tax. We want it to be protected. We want it to grow tax-free, and nobody can touch this money. I can use as a tax-free growth retirement. I can use for long-term care when I get older, as a cash value, as a death benefit, in a product called IUL, Index Universal Life. It's a lot of battle on social media. When people try to talk about IULs and whole life and putting your money to grow tax-free using either or other product, the people that preach those things, where they are battling, talking about one or the other, they are trying to push you to go with them, but they are not teaching you how to set up them proper and correctly, where most of your money goes towards cash value accumulation, and the death benefit is minimum. Because what they do it in the market, trust me, they're not going to like what I'm about to say. They wanted to make the death benefit bigger, so their commission is bigger, and less money go towards cash value accumulation. See, but they don't want you to know that. I'm going to take Andrew here. We're going to actually log into my back office, and we're going to start building a bank for himself for as low as 100 or 200 or 300 bucks a month, so that you can see how powerful this is. But this is a big no-no. They don't want me to show you this, but we're going to show here live in real time. It's about to go down. I told you guys are in for a treat, because it's about time. But the IUL, this is basically an electric fence that's built around this product, because it has the perks. It offers you protection, protects your family, your health, it protects your business, it protects your retirement. It protects you against stock losses, against creditors, against judgments, against levies, against death taxes, against bankruptcy. Have you ever wondered, after O.J. Simpson lost all his money, everything, bankruptcy, and right after that, next day, he was playing golf, using his wealth. Have you ever wondered where all that cash, all the celebrities that go bankrupt, and the next day they are traveling, having a great time? It's because the money that you have inside these products, remember, back in 1913, those rich families said, hey, nothing can touch this money. Doctors, oh my, if you are a doctor, if you love your doctor, or if you are a doctor, you wanted to call me, because you are protected against malpractice. If somebody sues you, guess what? If the money's inside here, they cannot touch. You see? That's why lawyers charge 5, 10, 20 grand to teach those things, sometimes per hour. It protects against student loans, against inflation, and against foreclosures. Again, nobody gonna ever teach you those things, ladies and gentlemen. I'm debunking and sharing with you guys what the wealthy doesn't want you to know. It works as an emergency fund. All the money that you put inside of it, if you need to borrow at any time to buy a house, buy a car, pay for the hospital unexpected bill. Maybe somebody died during COVID that they were not protected, their life or their family. You can use that money as an emergency. You can borrow against tax-free and take care of that bill. You have access to that money at any time. You can use as retirement. I like to call tax-free retirement. You can use for college savings and not go you set up a 529 and a college plan and walk away from those things. They are horrible. You want to just set up this for your children, set up a tax-free IUL account for your kids so that their money can grow tax-free. If you set it up this when they are born and you put $100 to $200 a month, you will have enough money when they turn 18 to buy Stanford and Harvard for 2 consecutive terms, and you still have some money left. You know, so, and it also has been, you can use as savings. Like I say, it's been averaging 10% in the last 40 years for all the people that we've been helping and serving. Like I say, ladies and gentlemen, the rich, they don't lose money. They don't like, that's why their money keeps growing and growing and growing. To set up, this is no medical exam required, and you can use it as a long-term investment. You want to let it sit in there and grow over the years so that you can build enough cash in there that one day you'll be able to borrow it when you need it, and when you're going to need it the most, which is later in life, during your retirement years, as you know where inflation is going, so you can combat inflation. I'm going to show you guys over here a tax factor. If you double a dollar 20 times, you guys have $1 million. But if you double a dollar 20 times and you have to pay taxes on those gains, guess how much money you have, ladies and gentlemen? $28,000 only.
Man,
What would you rather have in retirement? You know, $1 million and 48 or $28,000. That's why Albert Einstein used to talk about compound interest being the eighth wonder of the world. Tax-free compound interest on stocks that Carlos Siqueira can help you build it for yourself and your family for free at no cost, where you can do as low as $3 a day, is the eighth wonder of the world. Tax-free compound interest. Make sure that you take note of that so that we can teach that to your family, your loved ones, your neighbors, every single person that you know, my friend. That's 28,000 versus $1,048,000. Which one would you rather have, Andrew?
I need that million. I need that million, man.
You see why this is important? People, they don't want to teach because, you know, if you are paying all those taxes, guess what? Those taxes are going to the government.
Yeah.
You know? Do you think they want people to learn this? Do you think the schools and the banks and the corporations want you guys to learn this? It's just something to think about, you know?
Yeah,
because
that worries me because I have my business banking account, and what is the bank doing with my money?
Oh,
yeah. Are they just dumping it into all these insurance companies and getting?
Oh yeah, the banks, they taking the moment that you put your money in those banks, they are immediately leveraging that money, putting that money out there. They're getting 6 to 12% all day long, tax free. You know. So I want you guys to think about what is important to your family. Is it increase your cash flow, earn additional income, and manage expenses? Is it college funds, preparing for the children's future? Is it proper protection, protect against loss of family income and assets? Is it an emergency fund? Maybe you want to save 3 to 6 months of your monthly income. We live in crazy days. Is it asset accumulation? You want to outpace inflation? You want to minimize taxation and professional money management? You want estate preservation, build a legacy, minimize estate taxes. If you guys want a free financial need analysis, like I told you guys, just send me a DM. I can help you guys out. And it's for free. And I'm going to now show Andrew here in real time. We're going to go into my back office. Let me make sure I am logged in here. And we're going to build. I'm going to show you guys over here in real time. I'm not going to go through the entire process, but I'm going to show you guys a few cool things that this is a big no-no. They don't want you to know what I'm about to tell you right now. As I have a lot of advisors out there and agents from other firms coming to me right now, because not only I paid them 90 to 100% commission to start, and I showed them how to become a financial coach so that they can make a very decent living I also showed them how to give it away half of their commission so that the customer can have minimum death benefit, maximum cash value accumulation, which is much better for the client. But again, they don't want you to know what I'm about to share with you because they have to give it away half of their commission, and it's going to be better for you, my friend. And now we are going to debunk this concept. Are you guys ready? I know that some of you
Ready.
have
I'm
been
ready.
waiting for this moment, the moment that we all waiting for. All right. So now, let me open my screen. Andrew, you see my screen, right?
Yes, yes.
This is my back office. I'm logged in into National Life Group. I am contracted with them. I'm contracted with all the most top 30 powerful firms in America. They have trillions and trillions of dollars in assets. My family, my friends, my clients, we all use those companies. So I put my mouth where my money is. National Life Group has been in business over 174 years. So, Andrew, we are going to do a simulation here and build this for you. Andrew, what is your, give me the closest to your date of birth without giving me your date of birth.
May 1st, 1988.
All right. Again, we're doing this a simulation. This is private. Right now we're just simulating. Don't get all crazy on me here. We are gonna do a simulation so we can build this in real time. And now I'm gonna show you guys over here something that nobody would ever build an illustration with you in real time because they don't want you to know what I'm about to teach you, which is the proper way to set up an IUL, which will debunk any other product out there, is by setting up the way how I set it up. Right now, I'm just teaching you a few basic things, but once I talk to you one-on-one, we will go more in depth. But here's one item that they don't want you to know or click, which is the minimum death benefit, maximum cash value accumulation. See, they wanted to be able to go mess around with the other buttons so that if you are young, they can charge you more money for your death benefit, make the number bigger. Therefore, you're going to pay more fees, and there's less money growing tax-free. You don't want that. You wanted the other way around it. But when we select it this way, that means we agents, financial professionals, financial coaches, people that are helping people set up infinite banking concepts the right way, that will debunk any other product out there. It beats 401k, 401(b), it beats whole life, it beats everything because we are structuring proper. That's the key. Everybody and their mother is out there fighting on social media, on YouTube, talking about IUL versus whole life, trying to push you to go with them and their firms. But guess what? They're not teaching you how to set up correctly and proper because they don't want to give it away their commissions. I have agents on all 50 states with licenses, and we show families how to set this up so that you put the minimum death benefit, maximum cash value accumulation, so you can take all the benefits of the IUL by funded properly. So now the question that you wanted to ask is, what is the maximum amount of money that the IRS allows me to put it in before it becomes a taxable instrument? See, the IRS allows us to dump a bunch of money inside this, where you can set it up one for yourself, for your wife, for your children. You can pay for all of them, and you can stash it, all your money. I mean, you cannot get crazy on me to do like maybe have $100,000 death benefit and then do $1 million a month. No. Our IRS will not like that. But you see, that's why it's important that you understand you're dealing with somebody like myself that care for you, that's willing to give half of my commission so you have more money growing for you, where you are now becoming the bank yourself. That's why I'm not afraid to do what I'm about to do here. Even though we're doing a simulation, we put Andrew's close to his birthday, so we're not sharing any personal information here. This is a simulation so you guys can see in real time. And we did over here something magical, which is the minimum death benefit, maximum cash value. And now I'm not going to mess with anything else. I just want to show you guys one more thing over here. Let's say Andrew and you guys watching, my clients, they put anywhere between $100 to $10,000 per month. I deal with people, college students, all the way up to athletes and everybody in between. But let's say, Andrew, let's say you are a business owner, you know, you have family, you have children. So I'm assuming you're saving, you know, anywhere from $300 to $1,000 a month. But just let's say the person, the everyday person that's working hard, all you can save right now is $200 a month. And you are very similar to Andrew's age. So now let's say you're going to be putting $200 a month into, you are 64 years old. And then we are going to start taking money out by the time that we are 65.
Okay.
It's basically we become in the bank. It's almost like we're creating a mini pension. And again, this is what I'm about to show you guys is an illustration. The market has been performing, like I told you guys, in the last 40 years, about 10% a year return. The last 25 years, 20 to 25 years, has been averaging about 7%. So this illustration here, I'm running at 5.6%. I'm going way below what's the market's been averaging because I like to under-promise, over-deliver.
Yeah.
A lot of people out there, they want to show you guys big numbers. Like, no, I want it to go way below market average. What's going to happen, not a financial advisor or tax advisor, but think about it, what happened in 08. Market crash. We've been on a melt up for the last 12 years. Let's say the market crash this year or next year. What do you think is going to happen? It's going to go up for several years, and you're going to participate on all those gains tax-free, and your money will lock every time the market goes up, and you will not lose it when it crashes it. So you want to start building your own bank. And if you have any extra money, you want to actually dump a lump sum inside it and supercharge your bank. Whether it's 1,000 or 10 grand. Over here to see this button, first year lump sum, you can dump a lump sum in there. We're not going to play with that right now. Right now, all we're going to play is with average American might be able to save, let's say, $100 to $200 a month. So let's say you can save $200 a month. It's about $7 a day or $8. And then you're going to be contributing that into your 64. Let's say Andrew is 30.
Yeah. Okay.
And then you're going to start cashing out at 65 when you're going to need that money the most. Let's just go through a quick view over here. And again, this is an illustration. This is if the market performs a minimum at 5.6% year over year for the next 30 years. The market's done 10% on average in the last 40. The market has done 7.2 around the average in the last 25. I'm illustrating this here at 5.6%, going below what the market is doing. So as you guys can see, let's say if you are doing $200 a month, that's $2,400 a year. Policy year one, Andrew is 34 years old. He will contribute until he is 64. That's what is that? 40, 50, 60, 30 years.
Yes.
For 30 years, you'll be putting $200 a month, which is $2,400 a year. Starting at age 65, he can start taking annual income loans. If the market does 5%, 5.6% as illustrated, I'm not saying he's going to do it, but let's just say, what if it does? Now, Andrew, he put in $2,400 for 31 years. And at age 65, he can start taking $12,570 for another 60 years. If you guys are, I don't know if you guys are following me here. If you were to live up to 120, you could be taking $12,570 per year for 60 years, pretty much. But you only put it $2,400 a year for 31 years. And you're taking, what is that? 5, 6 times that amount for 60 years? See, ladies and gentlemen, what I'm teaching you guys here today, it's mind-blowing. And again, all those are illustrated numbers. I'm illustrating below market rate. Market has done way better than that in the last 40 years. I'm not saying that history will repeat, but if that's why we're illustrating below market rate. But just let's say if it does. Now you have all this money that you can borrow it, and guess what? You will borrow this money from yourself, and it's tax free. All the money that you put in right now in your 401k, 403b, Roth IRA, and all the other instruments out there, you have to pay half of that in taxes when you turn 65. And if you cash it out now, you pay penalties. So you lose 50% of your money, no matter which way you spin it, by following, again, not an advisor, but I do make a whole lot of people more wiser. Do your homework, question everything. And this is very powerful, but you have to ask yourself, why they don't want you to know this? Why they don't want you to understand how to become the bank? And I will tell you why. Because let's say 10 years down the line, Andrew accumulated here $21,382 in his policy. And now Andrew wanted to buy a car or do a down payment on a condo by the beach. And he want to put 1 or 2% on a down payment. And guess what? Instead of him going to the bank, now he can go over here and call National Life or go on his app and say, hey, I want to borrow the $21,000 that I accumulated in my policy. And they're like, no problem, Mr. Andrew. Here's the form. Sign it. You have your money in 3 to 5 business days.
That easy.
That easy.
Wow.
Now get ready to be mind blown.
Wow.
Get ready to be mind blown.
I am. I'm already. I've got pages over here. Wow.
Here's the thing now. When you borrow the money from yourself, you're not borrowing from yourself. You're borrowing the money from the insurance company. Your money's still growing inside the policy. I want to make sure you guys are listening to me. Let's say Andrew needs to buy a car or buy a house. He say, National Life, I want to borrow $21,000, the money that I accumulated inside my policy. Guess what? National Life is going to be like, okay, you have $21,000 there. We're going to use that as collateral. We're going to give you our money, Andrew. Remember, insurance firms has trillions of dollars in their assets. Trillions. They got to have 10 times more in their reserves. So they let you borrow their money.
Yeah.
Now they charge you 4.8% because now by law, when you charge 4.8% and is a loan, it's not a tax.
Yeah. Wow.
A tax event, ladies and gentlemen. I want you guys to heart it up and DM me and fire up the like button if you guys are watching me here live. And what I just told you guys here right now is how you become the bank yourself. And remember, we are playing with $200 a month. What if it would be 200 or 500 or $1,000 a month? Imagine how much money would you build inside here, where now kids need to go to college, need to buy a house, need to buy a car. You borrow it from yourself, pay it back at a low interest rate. Because check this out. Even if you are borrowing here, Andrew, 21 grand to go do a down payment on that condo by the beach or buy that car.
Yeah.
Guess what? You're paying them back 4.8%. But what if the market does 10% that year? They will credit you the difference. 10 minus 4.8%. You just came up 5.2%. Washing it.
Wow. You're making money. You're making money.
They don't want you to know this because if you would, everybody and their mother would do it. And that's why I talk about all the time, $3 to $7 a day will save on the way.
Quick question, Carlos.
Yes.
How soon can you tap into that money? You said
can tap as long as you see money accumulating in here.
Okay.
See, at the beginning, it won't accumulate as much.
Yeah,
right?
yeah.
There's some small fees that has to be paid at the beginning, right? Like, and as time goes by, as you guys can see, start digging it up. So whatever's accumulated in your surrender, you'll be able to borrow that money, and you'll be able to drop lump sums. And again, like I was told you guys earlier, over here is so here's the thing about this. 3 things are going to happen. Andrew, you could die tomorrow and not come back home from San Jose to your family. You could get into an accident and become paraplegic, and now you're no longer able to do the daily activities that you normally do. And, disability only pays $1,000 on average in California, unfortunately. And 3, you live way too damn long because of all the amazing garlic that you have. And now you need money for long-term care.
Yeah.
Those 3 things are going to happen, ladies and gentlemen. In all our lives, they are inevitable. They could have happened at any time. We could have died, we could have suffered an accident, or we live way too damn long. Are you preparing for those events? The sad story is that most people aren't. That's why we're seeing so many people raising money on churches. And this over here, becoming the bank, it fixes all that. Because if you die tomorrow, guess what? Andrew's wife would walk away with $159,000. They will cut her a check. If Andrew becomes paraplegic and get into an accident, or he become terminal illness, this doctor told me he developed cancer and might die in a year. Now they're going to say, Andrew, if you like, you can access most of this money within your policy, where now he can get a lump sum and to go enjoy his final year in this life.
Wow.
Or he lives way too damn long, and now he's accumulating all this cash inside here, where now he only put it $200 a month for 31 years, which is only $2,400 a year. And if he lives to 120, he's taking $12,000 a year for 60 years. It's way more money than what he put in. It's all met, ladies and gentlemen. That's tax-free compound interest on steroids for you. And that's why nobody wants you to know this, because if everybody would knew it, they would start doing it, and the banks would not have that cash anymore to go do what they've been doing with our money for the last century. This is a very powerful concept. Like I say, this is a $200 a month. Some of you guys, Carlos, I only have $100 a month. Okay, great. Let's see what $100 does. And let's say you are you like Andrew on your 30s or in your 20s. And now let's take a look and see what $100 a month do. That's $1,200 a year that you put in for 31 years. And age 65, you're taking $6,000 a year until you're 120 years old. You're taking almost 6 times what you put in for 60 years. And you only put in for 31 years. What if you like some of my clients? They are doing $500 a month. You're stretching, you're working a little overtime, you're doing a little Uber, whatever it takes. You need to save money, you need to counter against inflation. Let's see what happens. Now that's you contributing $6,000 a year for 31 years. Look how much money you're taking tax-free for 60 years.
Whoa.
$3,000. Literally, in $6,000 a year for 31 years. What is that? 6,000 for 10 years is 60. That's 186,000 in 31 years that you put in. 186. Dude, in 33 times 8, in 8 years, you take it already what you put in over 30 years. Mm-hmm. Everything from that on, you in the gang. I really hope you guys are following me here. If the market does what we illustrated here, even though this is hypothetical, but we are going underneath what the market has been doing. This is only 5.6% annual returns. The market has been doing 10% in the last 4 years. We have a lot of amazing things happening ahead of us. We're going to go through some turmoil in the next year or two, but all our money in here is going to be protected. So if you have a 401k, a CD, stocks, you want to cash that out. You want to do a lump sum and start allocating the money in different instruments, the things that I've been talking about, so that your money can grow tax-free. You protect your money from market losses and manipulation. And now you can start taking advantage. Because let's say, Andrew, you dump 10 grand over here and you supercharge this policy. Guess what? This is going to look way better now. Mm-hmm. But just say you're doing $500 a month. You do that for 31 years. That's 186,000 in the next 31 years that you put in. And you're taking 3,000 tax-free per year for the rest of your life. And even if, let's say, by the time that you're 90, let's say by that point, that's what, 30 years, right? 60, yeah. Let's just say 65 into 95. That's 30 years taking 33 grand.
Yeah.
That's like $1 million that you take out. You only put in 186. And if you die at that time, your family still get 31,000 left. As you guys can see, the death benefit that goes down here on the left because you are taking all this money, but it's still there. So your family still walk away with 31 grand to bury you. Mm-hmm. So as you guys can see, ladies and gentlemen, this is infinite banking on steroids. You become the bank. You can contribute as low as $100 a month and get very creative. And you guys can see over here on the far left, it doesn't create a MAC, which is a modify endowment, a tax event. You must understand how to set this up. The way how I set this up is very unique so that it benefits you, doesn't benefit the bank, the government. It doesn't benefit Carlos. I'm giving half of my commission because I want most of your money to grow. So that's a very tiny benefit for the amount of money that you are contributing. Very, very powerful, ladies and gentlemen. And there you have it. Infinite banking on steroids. If you guys want to get on a session with me, I know that we are almost an hour on this show. Went way longer than what I expect. But I'm very happy that we had this. And I want you guys to DM me. I want you guys to DM me Infinite Banking. You can text me 772-222-7567. Or you can DM me on Instagram at Carlos Inspire. We are getting dozens and dozens of messages on